Welcome back to Mortgage Markets and More. Happy Friday, everybody. As always, I am your host, Peter D'Angelo. I hope you're all having an awesome week. I'm thrilled. Hot off the presses today, we have the National Association of Realtors existing home sales data. So you all know my favorite time of the month to report out on this. This is, to me, something that's very valuable and helpful if you're a real estate professional for sure. But if you're a would-be home buyer, you can kind of get a sense of what trends are looking like right now, where things are at by way of the value in the market, the inventory levels, everything like that. So we're going to get into it. But as always, we'll kick things off with our average mortgage rates survey, according to Mortgage News Daily, as of recording this podcast the Thursday before its release. Starting off with the 30-year average fixed rate mortgage is coming in at 7.05%, slightly up from last week. The 15-year fixed rate mortgage is averaging 6.41%, also slightly up. The 30-year jumbo is averaging 7.22%. The 30-year FHA is averaging 6.44%. That was the one that saw the best improvement last week, and now that's nosed up a little bit along the lines of everything else that we're looking at. And the 7.6 SOFR adjustable rate mortgage is averaging 7.05%. We've been relatively flat here for the past 3 weeks. Things are kind of remaining stable. Here are some of the reasons why. First and foremost, no great shakes by way of economic data has been released. No comments by Fed members that move the market in any direction. We also haven't seen anything that's going to really move the needle much outside of some geopolitical things. And again, we've talked on previous episodes about this. It's kind of crazy. The war in Ukraine has an effect on what your mortgage rate's going to be. Geopolitical things that happen around the world affect particularly the financial markets. The financial markets are what has an impact on lending rates. The Fed is a big part of the conversation. Again, I'll reiterate, because they're trying to stabilize inflation, and as long as they're manipulating things in the market and they have adjustments to their monetary policy that are expected and talked about, they're going to have a role and have an effect on things. But the geopolitical tensions rose this past week since our last episode. Vladimir Putin made an address after some long-range missiles that were supplied by the U.S. were shot into Russian territory, and so he made mention of nuclear weapons, which causes an adverse reaction. People go to safe haven assets like bonds. So here's where we're at with bonds. The 10-year Treasury yield, as of recording this, is at 4.406%. That's down slightly from last week. Remember, more people who are buying bonds, prices go up and the yields go down. With a geopolitical tension, like I just mentioned, people are going to start investing in bonds a little bit more. That's an impetus. The 5-year Treasury yields at 4.277%, and the 2-year Treasury yields at 4.319%. So the 10-year and the 5-year are down a little bit, and the 2 years up a little bit. Overall, pretty flat week over week, remaining consistent with where interest rates are. There's not much more conversation about interest rates at this point, other than the one thing that I would like to mention today, which is going to be a hot take alert. I do not believe that the Fed really does have a good case at this present moment for cutting their interest rate like the market is currently trading. What that means for you is I'm just going to call a shot right now. I don't do it often, but I'm going to. Be prepared for some volatility possibly surrounding the Fed Open Market Committee, where they meet and then they make their announcement on monetary policy and whether or not they're keeping their benchmark interest rate the same, or if they're going to be cutting the interest rate. So I'm saying this now because, as we've seen in the past, if expectations in the market do not align with the actual monetary policy that gets announced, we have volatility. Volatility normally translates to higher interest rates. So as of recording this right now, on November 21st, be prepared for some possible volatility. Now, the fun stuff. My favorite part, we're going to get into the National Association of Realtors existing home sales data for the month of October, which was just released today at 10 a.m. The sales, 3.96 million units. That's up 3.4% from September of 2024, and that's up 2.9% from October of 2023. So we're seeing an upward trend that's continuing, if we recall what we reported out on for the September news release. Again, these are seasonally adjusted numbers. These aren't the actual number of units sold. The regional breakdown, we have the Northeast at 470,000 units. That's up 2.2% month over month, flat year over year. The Midwest saw 950,000 units sold. That's up 6.7% month over month, and that's also up 1.1% year over year. The South was the outlier, 1.77 million units sold, and that's up 2.9% month over month, 2.3% year over year. And the West saw 770,000 units sold. That's up 1.3% month over month and up 8.5% year over year. As you recall, it was the West that was a bit of the laggard in the data. And so it looks like that's bounced back a little bit. And seasonally, September, October, common times that people try to scoop up deals, purchasing vacation homes, second homes, or maybe even investment properties in the South. So that could be a reason for this translation of a little bit more activity happening in those markets. Now, for the median home prices for October 2024, let's take a look at this. Again, the median, this is the most commonly occurring number in the data set. This isn't an average. So the national median currently is $407,200. That is a 4% year over year increase. The Northeast, the average is $472,900, and that's up 7.6% year over year. The Midwest, $305,300, up 7.2% year over year. The South average, $361,200, up 0.9% year over year. The West, $627,700, and that's up 4.4% year over year. Home value appreciation is still absolutely ripping. And I know we've been managing a higher interest rate environment, but as you can tell, this high rate environment, even though we've had some opportunities of lower rates, particularly in the beginning of this year, and then we had another moment of relief just before things shot up again, leading up to and after the Fed rate cut in September, home value appreciation is still there. So for those who are looking for a good case to buy, that's it right there. If you purchased a year ago, if you decided not to get in the game, and if you did get in the game, then you'd be sitting on, let's say on average, almost 7.5% more equity if you're here in the Northeast. 7.5%. You're talking almost 10% appreciation on your property's value. Let's learn from that. I'm still making the case. It's a good time to buy right now, even with rates being where they are. Let's look at single family. So those numbers that we just talked about, those are encompassing all property types. Single family, multifamily, condo, co-op, the like. We're now going to laser focus in on single family homes and condo co-op sales. Single family home sales accounted for 3.58 million units that were sold in October, up 3.5% month over month, up 4.1% year over year. Sales is getting stronger. Last year was a tough year, so we could expect that this is going to be happening as we've been seeing some more consistency in the market. Condo co-op sales, 380,000 units sold. That's up 2.7% month over month. However, that's down 7.3% year over year. A little bit of a drop off there for condos and co-ops. The median price for single family homes nationally is $412,200. That is up 4.1% year over year. And the median price for condos and co-ops is sitting at $360,300. That's up 1.6% year over year. Inventory levels. For October, total inventory is sitting at 1.37 million units. That's down 2.3% from September and also up from October of 2023 by a factor of 19.1%. So the seasonality is showing us that we've got a much stronger October here than we had last year. And if we recall last year, rates were very high. Rates were very high. We started seeing the relief when we got into November and December, particularly when we saw the most improvement in inflation in December of last year, which set the stage for overwhelming optimism that created the lowest rate environment that we saw in 2024, which was back in January. We got very close there. We got very close there recently. We are closing out the summer, but didn't quite get to that level. The month's supply is 4.2 months supply. That's down from 4.3 months supply in September, but also up from the 3.6 months supply in October of 2023. More supply is required. As we know, we've talked about this a lot. Supply continues to be a major constraint to the real estate market. So we're seeing a trend that's developing in the right direction, but these are national numbers. When we start looking into the particular regions and market areas, it's going to start painting a different picture. Like I mentioned, I'm positioned here in New Jersey, so the New York metro area, very difficult market. Still, very low inventory. We're not going to talk about buyer composition today because we covered that a couple weeks ago when the National Association of Realtors released their 2024 all-encompassing buyer profile. If you're interested in that information, I will provide you with the link to that episode in this episode's description. However, let's just go over these highlights again. We got 4.2 months supply, trending in the right direction, even though month over month it's softened a little bit. Comes with the territory of the seasonality. So when we talk about month supply, there's no seasonally adjustment happening there. And as we go into the holiday season, it's to be expected a little less activity, but also with the interest rate environment being what it is, it's really difficult for someone to get off the fence and decide to move forward listing their home because A, where are they going to go if they need to stay local? And B, could be a little cost prohibitive. It's not as bad as it seems. I had a couple conversations actually just this week where I was comparing for someone, like if you have a 3% interest rate on your home and you're going to downsize and buy another home that's going to have an interest rate of 7%, they were like, oh, your monthly payment's going to double. And it doesn't. You're normally in a factor of anywhere, if you're downsizing, it's going to be better. But if you just kind of make a lateral move or an upsize, it's probably about a 30 to 40% increase in what your monthly cost is going to be. Because of that interest rate, you do capture the benefit of that extra equity that you get because you're a seller in this market. The regional sales growth, as we mentioned, the West led the way. They were also hurting out there for a while, so maybe we had some floodgates open up, and that's what caused quite a bit more activity happening in the West. The single-family home sales, pretty strong compared to what it's been like. So things are moving in the right direction there. And that median sales price, $412,200, we're creeping back up there. If you recall, I think I reported out on this earlier this year, but we saw it peak out like $417,000. So we're not that far away from where we saw a more recent peak in the past 12 to 15 months when it comes to the median sales price for a single family home. That's continuing to go up. I believe that a good amount of this is due to the fact that there's kind of an element of getting used to the market and getting used to what financing costs are. So as long as it remains consistent, if, like I said, I am going to be coming from a very grateful position. I am not going to get greedy. I would just love to see for all of the home buyers, prospective home buyers out there, and the real estate professionals out there who are working so hard because it requires so much work in this current environment. I want to see some consistency. That's it. I'm not calling for lower interest rates. We're not going to wind up seeing that. I kind of firmly now believe that, and it's going to take something to come out of left field, either an economic data point that was off and gets revised, like we saw, it happens, like we saw with the Bureau of Labor and Statistics with talking about the employment reports and how many jobs they overstated. So if something like that happens, that changes the narrative on people's perspective of the job market, there's one thing that can make interest rates go down. Nothing's showing us evidence of that right now. Secondly, if there's anything geopolitically that moves things in the market, that could move interest rates down. But yet again, one little thing, so little, but in grand scheme, the impact wasn't tremendous. But there's one thing that happened, as I was mentioning about the war in Ukraine, something like that. Okay, that can happen. But again, nothing's happening right now. Thirdly, we have an administration change. So anything from that could influence mortgage rates, but it could go either way. So if there's a piece of data or if there's an announcement, it could move the markets in different directions. So that's why I'm not getting greedy. I don't need to see interest rates come down. I just want to see stability. So everyone can have expectations and properly proceed with those proper expectations. Looking into the sales data, let's also think, what was the financing cost like? That's a huge component. I just, spent the past minute and a half explaining things about the interest rates moving forward. When we look at these sales numbers for October, what was it costing? Well, September to October was a bit of a wild ride because that's when we had the Fed rate cut announcement in September. So on September 26th, Freddie Mac's average mortgage rate was averaging 6.08%, 30-year. And that's September 26th. That was right around the Fed Open Market Committee meeting. Then by September 30th, went to 6.22%. By October 11th, the 30-year fixed rate was averaging 6.52. That was the couple weeks we saw a big jump. And then by October 25th, 30-year was averaging 6.76. I'm talking that late into September because of the sales cycle. On average, homes are being purchased, they're getting under contract and sold within a 30 to 45 day timeline. That means those buyers are likely locking in their interest rate 30 days prior to their sale date. So it could be as early as the beginning of September or as late as the very end of September, or actually locking for those who are, getting delivery of their financing more quickly than the average, like we do at Rate. Then maybe they had their rates locked in October and closed in October. So that's why I want to give you the full scope. That increase can show why we are seeing some of these changes in the sales data. So the next release is going to be December 19th. I'm looking forward to sharing that out ahead of the holidays. And then we'll get a sense. We're going to do one bigger episode this year, like we did last year. That's going to be our 2024 year in review for real estate and mortgage rates, as well as all the news and all of the opinions that I'm sitting on that I'm going to share about what I'm thinking about 2025 and where I have my expectations set. And I hope that you'll find it interesting and helpful for you if you have goals of homeownership in 2025. That's it for me today. I hope you found all of this information helpful and useful. Please do reach out to me. You can reach out to me via email at peter.d'angelo@rate.com. You can follow me on socials. Everything is linked in the description of this episode. I'll look forward to a more normal episode next week with our rate review, a couple things that we're going to touch upon, and some interesting statistics that I think will help us to generate an idea of what we could be expecting, particularly over the next month to 3 months. Until then, have yourselves an awesome weekend and have a happy Thanksgiving. I will be catching up with you on Black Friday after Thanksgiving. Have a great weekend and take good care.